Hello, everybody. My name's Corey Kramer, and this is the Cyclical Investors Club YouTube channel. Today, we're going to make a different video than the normal individual stock analyses that I post. I've had a few questions now from beginning investors and people starting to learn how to invest better about some tips and lessons on how to perform better at individual investing. So this is going to be a video where I'm going to share a rule or a guideline that will pretty much prevent you from making the mistakes that 80 or 90% of individual investors are going to make. And probably even more than that, but it's hard to know for sure. So let's, and this really isn't an exaggeration. I see it every single day. I see this not being followed and then poor results happening because of that. So there's a bit of a series of arguments that I'm going to make here, but they're simple. So as Warren Buffett has said, the number one rule of investing is don't lose money. Okay. And then the number two rule is never forget rule number one. So you want to ask yourself, and that's a great quote, but it doesn't tell you how to avoid losing money, right? And there's lots of ways to do it, but I think the first steps to not losing money are to understand in stocks is to understand that stocks are a partial ownership of a real business. So you need to think of yourself as a partial owner of a business when you buy a stock. And then you want to think, okay, well, which businesses don't lose money? Well, quality businesses don't lose money. So if you buy a quality business, almost by definition, over the long term, you won't lose money. And so the question then comes, well, what is a quality business? Like, what does it mean to be a quality business? And my definition is a business that grows earnings faster than inflation. So the key benefit of owning a stock versus owning a bond, with a fixed income or any kind of fixed income really, is the income is fixed, right? That interest rate is fixed. So if you buy a bond that yields, I don't know what the 10-year treasury yields now, like 4% or a little over 4%, you will get 4% a year if you hold it to maturity from the bond. If inflation is 4%, then your real return is nothing. And if inflation's 5%, you lose money in real terms. Even though you get all your money back plus 4%, you still lose in purchasing power. So the benefit of owning stocks is if you own the stock of a high quality business that can grow their earnings faster than inflation, then you can earn money even if inflation goes up unexpectedly, because inflation is the great unknown. Basically, nobody knows what it's going to be, but if you have a business that's a quality business, that they can raise their prices along with inflation, and that will be they will be able to pass those costs on. So the long-term stock price follows the long-term business earnings. Now, there can be other factors involved in that, but we're trying to keep it simple here. I posted this of AutoZone, which we're going to look at in a minute, but it's a straightforward example, so I wanted to show that if you could have predicted AutoZone's earnings back in 2005 or whatever, what they were going to be in 2015, you could have pretty much gotten pretty close to what the price was going to be. And if you could have predicted in 2015 what they were going to be here, you pretty much could have predicted what the price was going to be here, right? Over the long term, the price will follow the earnings, all right? So you want to buy a share in a business where earnings are growing faster than inflation, or you think they will grow faster than inflation. Now, I have a strong bias toward what have they done historically, and I usually let that guide me with a standard analysis that you guys see me do here on the YouTube channel. That's what I let guide me into the future. So when I bought AutoZone, let's shorten this a little bit. I actually did buy it right at this bottom, and I still own it. So because earnings had been growing, I estimate their earnings grew like 10%. These are inflated because they buy back a lot of their shares. They don't pay a dividend or anything. So I figured earnings were growing about 10%. I bought it maybe about a 10 PE, 10 or 11, which is pretty cheap. And then earnings kept growing, and then because it was undervalued, I get a little bonus from that. But you're going to get good returns when you buy something that's cheap like that, where the earnings keep growing. But the point is, it's a quality business, and I'm going to show you a business where that isn't true, right? In the exact same business. But first, let's look at O'Reilly. So these are auto parts. These are all going to be auto parts places. So let's look at O'Reilly's historical earnings. Well, they look a lot like AutoZone's, right? So this is a pretty good area to be growing your business in retail auto parts. And yeah, it's a little more expensive than it has been. Well, it's probably similar to what it was back here, but as earnings rise, which is this dark green area, the price rises. So a few months ago, or actually it was last year, I made a video on advanced auto parts. And the point I was trying to make with advanced auto parts was, once you control for a few other things, when you take a time frame from like this time frame right here, their earnings growth at that time, this was before the stock price and this collapse happened here, but their earnings were only growing about 3%, if I remember correctly. So, and inflation is growing faster than that. So it wasn't a quality business, because we know they had the ability, in theory, in their industry, to grow earnings at 10% or better, and they were only growing at 3% for a long period of time, while their competitors were growing faster than that. Not just one, but two. So this is a company in the same business, the same industry, that wasn't a quality business. They weren't able to grow earnings at a faster rate than inflation. So even though it looked a little attractive when it first started falling down here, I rated it a sell, and I warned people about it. Well, for me, those earnings are too slow. It's not a quality business. And then after that, then earnings fell off a cliff, and now the price is way down here. It's like fallen 50% more. So that's a good example of just, and you can look even before this giant drop, you can see that these earnings are not nearly as steady and predictable as AutoZone and O'Reilly's. Now, part of that's because they were buying shares, but part of it's just because this wasn't a quality business, a high quality business. And you can see how the price of the stock, when earnings fall, the price of the stock falls too. They don't always fall proportionally, but they generally, you can see the pattern. When earnings were going up, the stock price was going up. When earnings going down, stock price going down. So in most cases, all other things being equal, find a business that has a history of quality earnings growth, especially through at least one recession. That helps, because sometimes they can be cyclical, and you can categorize them differently and things like that. But about half of the S&P 500 stocks, they aren't going to be nearly as clean as this one. This is like a perfect example, but they will be relatively predictable. And now, during the life cycle of a business, at some point, businesses will fail, and earnings will come down. That's just part of the thing. If you look at like an IBM, is a good example, right? So it was a growing business, everything looked good, but then you started to see some of this weakness, and there would be other signs as well. And then there's a point where, okay, well, their earnings aren't really growing, and so by the time you get in here, you can say, okay, well, maybe that's not such a great investment anymore, and it's only returned a little bit per year, and most of that's been like in the past like couple months. So if you had bought back here, and held through there, you're only getting a couple percent, which is less than inflation. Now, maybe it looks like maybe they're starting to turn things around a little bit, but you can see that this isn't what you want. You want earnings to be growing faster than inflation. So that's why Warren Buffett ultimately sold it. He bought it when it was looking pretty good. Once several years went by, I think he owned it like 7 years, and several years went by and they weren't growing, then he sold it. Same thing with Wells Fargo. Let's take a look at them. So I forget when he sold. Was it before? I think it might have been. I can't remember if he sold before. I think it was after. I think it might have been over here after this dip. But there were signs, I think, going even before that for me that Wells Fargo was a sell. And but you can see it grew, and now it's not growing anymore, or it hasn't been. So that wouldn't be quality. When you can go and find a quality competitor. I've talked about some of these before, but something similar like a PNC, it's still growing. It's choppy. They have all these things going on, but they're still growing over time. So yeah, number one tip, it's really two tips. One, stocks are partial ownership of a business. Two, the stock price will ultimately follow the earnings long term. And three, you want earnings to be growing faster than inflation because that's one of the key benefits of owning a stock. So if you look at this bout of inflation that we had recently, once we work through all this, the quality businesses will, if you look at Microsoft, I'm just randomly picking them, when you have 20% inflation, they can pass that on to their customers, which they were doing here, so they had the ability to do that. Some companies are not going to have the ability to pass that on. If you look at a Dollar General, right? So they got an initial boost, but then once the initial phase was gone, now these earnings are coming back down. Now that doesn't mean longer term they can't. They had a longer history where they did grow earnings, so this is kind of a COVID thing, But yeah, a quality business will be able to pass those costs on to their customers, and that's what you want as a stock investor because it means you don't have to predict inflation. If you're a bond investor, you'd better have a good idea what inflation is going to be, because if inflation is more than the interest rate that you're getting, you're losing money, and that's the number one rule that we don't want to have happen. All right, so the next step would be how much are you going to pay for those earnings, right? So that would be maybe a next video. But honestly, I see 90% of the talk in the media, in the financial media, is focused on the short term, and it's not focused on the business and actually what they're earning. They might focus on the business, but it'll be like stories and stuff. It's not that their earnings trend. So, and most investors are not, they are focused on it, but often it's short term, right? If a company only has a 5% earnings yield at 20 PE, it's going to take them 20 years to pay you back your money if it isn't growing with the earnings. So that's a long time. So if it moves in one quarter and people are trading it, it doesn't make a lot of sense most of the time. So they're trading from a business perspective, right? From a stock perspective, it might. You can trade it and do things like that. But from a business perspective, if it was a farm or something, it just wouldn't make it, and you had bad weather one year, you wouldn't devalue your whole farm over the next 20 years based on it, right? So most of the financial media is not focused around actual thinking of stocks as businesses. They think of them as trading vehicles, mostly to try to take retail investors' money. But that's a separate topic. Thanks for watching. If you found this useful, hit the subscribe button. I do a lot of individual stock analyses, so it's really like a case study by case study. Sometimes I pick some that I think actually are important to like to have some lesson there, kind of like the ones that I showed in this video. But most of the time I just take requests, and then whatever there is to learn from that particular stock that day, that's what I talk about. So thanks for watching, and I'll see everybody later. Bye.